go from that. In my view is that all this Euro doom and gloom is overdone. A Greek debt default or an Irish debt default cannot be ruled out. My view is they're more likely than not, but neither can we rule out a default by the city of Los Angeles or Nassau County, New York. But, you know, a default by Nassau County, New York would not spell the end of the dollar area, and similarly, a debt restructuring by the government of Greece or the government of Ireland would not spell the end of the euro. Moreover, a country like Greece would almost certainly make its problems worse by attempting to reintroduce its own currency. And I think Germany, for its part, has too much invested in the larger European project to turn its back on that now, which is what Germany itself abandoning the euro and reintroducing its Deutschmark would mean. So Europe is now going to have to fix its monetary union, or more precisely, complete its monetary union. The euro area has shiny coins and beautiful banknotes and more than decent central bank, but it doesn't have the other elements yet of a functioning monetary union. What the debate in Europe is about at the moment is how to put those other elements in place. And I think that's what they will do in the end. The father of European integration, Jean Monnet, the French technocrat, said Europe is forged in crises. What he meant was every time they're faced with a crisis, they have to decide whether to go back or go forward, and they go forward. And I see every indication that they will do that again once the stability of the euro area and confidence in the euro is restored. I think the euro will be ready to take its place on the international stage. So much for the euro. Then there are the challenges facing the dollar. I will be brief on those, but I conjecture that we'll talk about them quite a bit in the Q&A segment later. The challenges facing the dollar emanate from debt and deficits, and the debt and deficits problem emanate from dysfunctional politics. So I see no indication that the debate going on in Washington at the moment reflects seriousness about trying to come to grips with the medium-term fiscal challenges that the country faces. I come across the bridge from Berkeley, California, so you can infer my politics, but I think the two things arithmetic says, the two things that we will have to do to close the budget deficit, prevent the public debt, government debt from exploding, and avoid a collapse of confidence in the dollar are to head off what will be the explosive growth of healthcare costs and raise more revenues. So call it revenue enhancement, call it raise more taxes, think of it as you will. But arithmetically, I think those are the two essential things that we will have to do. And if we don't, there will be pressure on the Fed not to raise interest rates when inflation heats up next time. The fact that we have a government debt to GDP ratio approaching 75% in the United States is not a big fiscal burden at the moment when interest rates are close to zero still. But when they go back to normal levels, it will be a considerable burden. It will mean that we will be devoting a quarter to a fifth of all federal tax revenues to servicing the debt. And to keep us from getting into that mess, there will be all kinds of political pressure on the Fed not to allow interest rates to rise back to normal levels. We will end up inflating away the debt in effect. In that scenario, it will be even more tempting to inflate away the debt insofar as a majority of U.S. Treasury debt is now held by foreigners. But foreigners will be able to see perfectly well what would be coming under that scenario, and they will want to get out of the way before it happens. So that, that is the scenario in which there is a sudden loss of confidence in the dollar. Foreigners scramble to get out, the dollar exchange rate crashes, market interest rates shoot up, important investors are wrong-footed, and there are all kinds of dire financial consequences. So there is a situation in which the dollar loses its exorbitant privilege as the global currency, or one of two or three global currencies, but it's not a scenario in which the Chinese do it to us. It's a scenario, it seems to me, fundamentally where we do it to ourselves. So a couple of USF colleagues were asking me earlier, am I pessimistic about the dollar? I'm hopeful that the United States will come to grips with its fiscal challenges, and if we do, there is no reason to be pessimistic about the dollar, but there is a darker scenario as well. Finally, my third candidate is China's currency, the renminbi. In order to make its currency attractive to companies around the world for invoicing and financing their foreign trade, in order to make the renminbi attractive to financial institutions as a currency in which to offer deposits and make loans, to make the renminbi attractive to central banks in other countries as a currency to hold as international reserves, China is going to have to fundamentally transform its development model. It's going to have to open its financial markets to foreign investors. Doing that safely will require it to let its currency fluctuate more freely. To gain the confidence of international investors, it will really have to establish rule of law. So when you think about that, that is a formidable challenge indeed. It would entail a fundamental transformation of the Chinese development model, which has been based on keeping its financial markets closed to most international flows, keeping its currency low and pegged to the dollar, and not worrying too much about rule of law. So China is going to have to move a long way quickly, and my view is that it is intent on doing exactly that. We have underestimated the Chinese before in how quickly they can move economically. I don't think we should underestimate them again. So high Chinese officials have said, our goal is to make Shanghai a leading international financial center by 2020. By implication, letting foreign investors come in, come out, use China's own currency freely by 2020. And they're moving really fast. So a year ago, exactly 0 companies used China's own currency for their cross-border settlements, for their foreign trade. At last report, I saw 70,000 Chinese companies are using China's own currency in cross-border settlements with foreign companies. There are now something on the order of, I think, 47 foreign companies that have issued renminbi-denominated bonds, dim sum bonds, they're called, in Hong Kong, starting with McDonald's and Caterpillar, with a lot of others that have followed. You can now open a deposit account in Chinese renminbi in New York. The Bank of China, the commercial bank, not the People's Bank of China, the central bank, will, you can open it over the internet, in fact. It's FDIC insured, and it has a cap of $4,000 on it, but that will go up over time. So they're taking all kinds of steps designed to internationalize their currency. And I would suggest that history shows that it is possible to do this successfully in a period as short as 10 years. In particular, the history of the United States shows that this is possible. So, in fact, the dollar was not used internationally at all in 1914. The dollar accounted for exactly 0% of the foreign exchange reserves of central banks around the world. 0% of international trade, including the imports and exports of U.S. firms, were financed in dollars in 1914. When U.S. companies needed trade credit, they went to London, the leading global financial center, and got it in pounds sterling from an English bank. So American firms were not happy about this, having to go to London and deal with a foreign bank as well as a domestic one, bearing the risk that the exchange rate could change, was a competitive disadvantage for them. So they got important politicians like the senator from Rhode Island, Nelson Aldrich, related to the Rockefellers, important financiers like J.P. Morgan and Benjamin Strong, who worked for Morgan, to change this state of affairs. They created the Federal Reserve System in 1914, in part to provide liquidity to a market in securitized trade credits. They allowed U.S. banks to branch abroad and originate this international business for the first time, again in 1914. By 1924, only 10 years later, the dollar had overtaken the pound sterling as the leading international currency. More international reserves were in dollars than in pounds. More trade was financed in dollars than in pounds. So our own history in the United States suggests that if you're intent on internationalizing your currency, and if policymakers provide the relevant support for the process, you can undertake that transformation quite rapidly. And that's exactly what Chinese policymakers want to do at this point in time. I think they see that their companies having to do their international business in dollars is a competitive disadvantage for them. Their banks can't get a slice of the international financial pie because they can't do international business in their own currency. That's exactly what Chinese policymakers are intent on changing now, and I wouldn't, as I said, underestimate them. So I conclude the dollar, the euro, and China's renminbi all have their problems, but the very fact that there are doubts about all three is reason to think that there will be a place for each of them. So I think for all these reasons, a global monetary and financial system organized around several important national currencies, the dollar, the euro, and the renminbi, is coming. And the question is whether we should worry. Some people say we should worry because such a system would be dangerously unstable. There would be three important currencies that were traded internationally, and if doubts arose about one of them, central bank reserve managers would quickly shift out of that currency into the others. So the currency about which they had doubts would crash, and the others would shoot through the roof, and the whole system could be dangerously unstable. This worry, in my view, is in fact based on a mischaracterization of the behavior of central bank reserve managers. Central bank reserve managers are not hedge fund managers. They don't behave like hedge fund managers, partly because they're not compensated like hedge fund managers. They don't get 20% of the profits. And partly because they have social responsibilities, and they know it. They have an interest in the stability of the system, and they act accordingly. Private investors, hedge fund managers, when they see everybody running away from a currency, are tempted to run away from it as well, to run with the financial herd, if you will. Central bank reserve managers tend, in fact, to act as contrarians. When they see an individual currency beaten down, they move in and buy it while it's cheap, in part in order to be able to rebalance their portfolios. There's systematic work by economists at the Peterson Institute in Washington, D.C. that shows this is the case. If you want a concrete example, the dollar weakened in the third quarter of last year, the most recent quarter for which we have data on what central bank reserve managers were doing, and they were buying dollars precisely when it was weak. So I am not overly concerned about the stability of this new system. To the contrary, I think it may be better performing than the one with which we have been living. What would not be helpful from a stability point of view, and with this last point I will conclude, is to try to stabilize the exchange rates between the three major international currencies, the dollar, the euro, and the renminbi. I think that economic conditions will continue to differ between the US and Europe and China. Appropriate monetary policies will be different as well. So to try to stabilize the exchange rates between these currencies, efforts to do that, I believe, would quickly become undone. Last August, French president, the French always figure in these stories, French President Nicolas Sarkozy was looking forward to January 1st of this year when France took over the presidency of the Group of 20. He was speaking to the annual assembly of France's foreign ambassadors in Paris. And he said, when we take over the G20, we will make international monetary reform our priority, and we will try to stabilize, get an agreement to stabilize the exchange rates between the dollar, the euro, and the renminbi. He's been backpedaling, fortunately, ever since. And now he talks about the need to think about the multiple international currency system that is coming and how to manage it in such a way that it will be stable and smoothly functioning. I think that's reassuring. That's intellectual progress, if you will. So I think I can see relatively clearly where we will be 10 years from now. Getting from here to there will be the hard part, if you will. But I have more confidence than I did 2 or 3 years ago that we will succeed in doing that. So thank you very much. I'm happy to take questions.
You left out all your humor. When I was reading the book, I was laughing because you had a movie that you'd gone to see. It was set in Cambodia. An American had been taken as a hostage, and those holding him wanted ransom. And they were initially going to be offered Cambodian money, and they said, no, 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 no. We want the ransom in dollars. And in fact, your book is loaded down with references back to film, so apparently you spend some time in that arena. And it enriches, I think, the writing that you give to the rest of us. Before I turn the microphone on to my colleague here in the front row, I'd like to ask you, a number of people in the Academy are deeply worried, and so they have created a school of declension, the decline of the United States.